Hi, welcome back. In this session, I'd like to draw a contrast between good companies, good managers, and good investments. The reason I want to draw this contrast is too often when you're given investment advice, that investment advice blurs the line between good companies, good managers, and good investments. In fact, all too often you're told just find a good company with good managers and you can't go wrong. But that's not true, right? You can have good companies with great managers that are bad investments, and you can have awful companies with inept managers that are good management, that are good investments. Maybe it's how can that happen? To draw the contrast, I'd like to start off by defining what I mean by good and bad companies, how I would draw a contrast between good and bad management, and how I would draw a distinction between good and bad investments. Let's start with good and bad companies. There are lots of proxies you can use for measuring the goodness of companies. Some people look at pure profitability. If a company makes more money, it's viewed as a better company. But that's not necessarily true, right? Because it depends on how much capital you've invested in that company and how much risk you take. There is a measure that we use, which, in spite of all of its limitations, is a fairly decent measure of company quality, and that's the excess return you earn. That is the difference between the return you earn on your invested capital and your cost of capital. If you draw that distinction and you look across the globe in January 2017, as I did a couple of months ago, here's what I found. Looking across the world, there are about 11,000 companies that are good companies, companies that earn more than their cost of capital. About 19,000, perhaps even closer to 20,000 companies that earn well below their cost of capital, and about 4,000 companies that run in place, that essentially earn their cost of capital. Now, this might be simplistic, but you could view the 10,947 companies that earn more than their cost of capital as good companies, and the 19,960 as bad companies, and the 4,000 run in place as neutral companies. Now, if you think about good and bad companies, that distinction works. Now, what about good and bad management? To me, good and bad management is really about living within your limitations. So here's what I mean. If I give you a young company and you're a great manager, what do? You got to pick great investments. You don't borrow much because you can't afford to, and you don't want to risk your future growth, and you don't pay out much in dividends because you need every dollar of cash you get to reinvest back in the business. But if I take a great management and put it into a mature company, your job shifts, right? Your job is playing defense, protecting your competitive advantages, perhaps using debt more to take advantage of the tax code, and usually returning more cash to your stockholders. But what if you're a great manager in a bad company, in a declining company? In a declining company, I would argue your job as a great manager is to actually not just not make investments in a bad business, but actually get out of businesses. Your job might be to shrink the company, make it smaller over time. One way to measure the quality of management in a company is to actually value it twice. Once with the existing management in place, so basically you get a status quo value, and once with what I would call optimal management. What does that mean? I take your company and I say, if you had an optimal manager running in this company, how would investment financing and dividend decisions be made? Now, if you look at the difference between your status quo value and your optimal value, I call that the value of control, but it could also become a measure of the quality of management in a company. The better the quality of management in a company, the smaller the difference should be. And at the limit, if you are perfect at managing a company, the difference between those two values should go to zero. Now you can already see why you can have a bad company that is well managed and a good company that is badly managed, because you have to deal the hand that you were dealt, and good managers take the maximum benefit from the hand they've been dealt. Now let's talk about good investments and bad investments. You cannot talk about investments being good or bad without bringing price into the equation. And here's why. When you think about value, your value reflects your cash flows, growth, and risk, and essentially it reflects how good you are as a company and how well you're managed. That's the value of a company. The price reflects the market's perception of how good you are as a company and how well you're managed. So if you have a great company, really well managed, and the market thinks you're a great company that's really well managed, you've got a match. If you're a really bad company or ineptly managed, the market thinks you're a really bad company and ineptly managed, you have a match. The essence of investing, of finding good investments, is a mismatch. What does that mean? You have a good company with good managers, and the market treats you as a bad company. That's a mismatch. That's your buy. If you have a bad company and the market treats you as a good company, that's a mismatch. That's your sell. So you're essentially looking for mismatches in markets. Now let's make this real. In most cases, when people try to make investment decisions, they have either pricing myopia or value myopia. What's pricing myopia? You can entirely focus on the pricing. You look for cheap stocks. If you look at multiples, here's what it translates into. You buy low PE stocks, low price to book stocks. Think of how much of old-time value investing is focused on just the multiple. The problem is most low PE stocks deserve to have low PEs. It's because they're not good companies, so they're badly managed. Most low price to book stocks deserve to be cheap. So when you're focused just on the pricing and you don't bring in the value component, you could end up with a portfolio that looks cheap but deserves to be cheap. At the other end of the spectrum, you have people who spend all their time looking at the quality of the companies, how well they pick projects, what their moats are, what their competitive advantages are. All good, right? But if you focus entirely on value and ignore the price, you might have a group of really good companies in your portfolio, but terrible investments because you bought them at too high a price. The key then is to bring both halves into your decision process. So here's a simple way to do it, staying within the rubric of multiples. Let's say your choice of multiple is price-earnings ratio, and you want to bring in both sides of the equation. Here's my suggestion. Start with the simplest equity valuation model you can think of. The one that I can think of is the dividend discount model, a stable growth dividend discount model. It's called the Gordon growth model, the oldest discounted cash flow model in use. Value of equity per share is expected dividend per share next year divided by the difference between cost of equity and growth rate. Now divide both sides of that equation by earnings per share. You're allowed to do it in an equation. It still stays an equation. Dividing the value of equity per share by earnings per share gives you price earnings ratio. Dividing dividends per share by earnings per share gives you payout ratio. You think, so what? The price earnings ratio for a company is a function of three variables. Its payout ratio, its cost of equity, and its expected growth. In fact, I can go further. If you're a company with higher growth, I'd expect you to have a higher PE. If you're a riskier company, have a higher cost of equity, I'd expect you to have a lower PE. If you can pay out more of your earnings given a growth rate, in other words, you have a higher return on equity, I'd expect you to have a higher PE. So essentially, when you look for a cheap stock, you have to bring these fundamentals into the equation. So in the case of PE, if you pick stocks which just have low PE ratios, you might get a lot of companies with low returns on equity, high risk, and low growth. You want a mismatch. And your mismatch, if you're looking for the perfect undervalued stock with PE ratios, will have a low PE ratio, not surprising there. It'll have high growth. You want a mismatch, right? You want low risk and a high return on equity. If you think about the screening process in investing, that's what you're trying to do. Get that mismatch in your screens. A stock that's price cheap, but actually has a high value. In fact, if I extend this process to other multiples, and I've done this for 6 other multiples, I've identified the mismatches I would look for with each multiple. That would give me a cheap stock with that multiple and a mismatch for an expensive stock. So as an example, with price to book, I want a low price to book ratio. I want high growth rates. I want low equity risk and high return equity. If I have an enterprise value to EBITDA multiple, I want a low EV to EBITDA for a cheap stock, a high growth, low operating risk, and low tax rate. You think, what's the difference between low operating risk and low equity risk? Operating risk comes from your business. Equity risk is whatever that operating risk is, magnified by how much debt you've chosen to take. This is a game of finding mismatches, and when you look at multiples, that's effectively what you're looking for. So here's the bottom line. You can have good companies, and good companies bring strong competitive advantages on big excess returns. In well-managed companies, here's what you're going to see. The management is doing the best with the hand it was dealt. Doesn't mean the company is going to be growing fast and earning high excess returns, but the managers are doing the best they can with the company they've been given. In fact, you could argue that bad management often overreaches. It tries to do things for companies that is beyond their reach. And good investments requires that you be able to buy these companies at the right price. Good companies are not always well-managed companies, and well-managed companies are not always good investments. Now, in a perfect world, would I like to buy a great company with great management at a great price? Of course. And in fact, if you ask me to put a hierarchy of investing, here's what I would like. I'd like a great company with great management at a great price. That's my emphatic buy. Most of the time, though, that's tough to find. So if you gave me a company with great, which is a great business, with bad management and a good price, I would buy the company and hope for management change. If you give me a bad company with good management and a good price, I'll buy. In fact, anytime the price is less than value, even for abysmal companies, I'm more likely to buy than sell. Conversely, if the price is not right, if it's higher than the value, I don't care how great you are as a company, I'm not buying. In fact, you could argue that if you have a bad company with suboptimal management and a bad price, that's your emphatic sell. So you can come up with your own ways of ranking these companies. But to me, the essence of investing is not just understanding value, but recognizing the price you're paying for that value. I hope you found this useful. Thank you very much for listening.